Bucking the forecast, China is teasing the market with upbeat economic figures. The market consensus points to the slowest annual growth in the first quarter of this year for China since the 2009 financial crisis. But China's top economic planner, the NDRC, says China used more electricity in Q1 than in the same period in 2015, and the pace of growth quadrupled from a year ago.
We see stronger demand for power in the services sector and households, which contributed 3 percentage points to the increase in total first quarter power consumption.
Meanwhile, the industrial sector also bought more electricity in the first quarter, reversing a downturn but only posting a marginal recovery. What could be a relief is that diesel consumption, which reflects industrial and agricultural activity, surged 3% in March, flipping a yearly drop in the first 2 months. On top of that, China approved more than $850 million in fixed asset investments in March. Analysts say China is still banking on such investments to boost economic output. The NDRC says the downward pressure on China's economy hasn't disappeared, but companies are feeling less strain on their finances.
On the back of a recovery in demand and a narrowing drop in factory gate prices, industrial firms in China had new profits of 35.5 billion yuan in the first 2 months this year, up 4.8%. That changes the downward trend of 2015. It's the first monthly gain since last June.
But the downside is those companies are still heavily in debt. Financial Times estimates China's total corporate debt stands at 160% of the GDP, while the overall debt level is still twice the size of the economic output.
The fact that credit is continuing to grow faster than GDP, it's programmed to grow faster than GDP again this year. We think that there's still maybe some room for growth, but that there are limitations to this model. Also, given that a lot of this money we know is flowing to government or organizations with government guarantees, so the allocation of this credit might also not be the most efficient, this new credit.
The issue has also been recognized by the People's Bank of China in the middle of an overseas assets shopping spree by overborrowed Chinese companies. Recent months have shown that any shock to the stability of China's financial system would trigger panic among global investors. Analysts say the PBOC is ready to open fire on money supply to meet growth targets and help debt-laden industrial firms refinance expensive debt. The analysts also say it's key for China to work off the debt-fueled growth since 2008 to reach a services-heavy economy and to secure the confidence of global investors. Xia Cheng, CCTV, Beijing.